Welcome to the C-Suite Series presented by Channelchek and Noble Capital Markets. Noble is an SEC-registered, FINRA-licensed broker-dealer and the source of the equity research available on Channelchek. Of the 6,000 small and microcap companies listed on the site, today we're featuring KELYA Services. Joe Gomes, Noble's senior research analyst covering the company, will be interviewing CEO Peter Quigley. Afterwards, he will be joined by Michael Kopinski, Noble's director of research, to discuss the key takeaways. As a reminder, Joe's research is available at no cost on Channelchek. Just type in KELYA Services in the top left Company Data section. And now, here's Joe and Peter.
With us today is Peter Quigley, President and CEO of KELYA. Good afternoon, Peter, and thanks for taking the time to sit down with us.
Glad to be with you today, Joe.
So KELYA has a 74-year history as a leading workforce solutions company. It is one of the most recognizable brands in the industry. The company seeks to understand the world of work. For those in the audience unfamiliar with KELYA, can you talk a little bit about the company's history, what you do, your refreshed brand, and some of the clients you support?
Sure, Joe, I'd be happy to, and great again to be with you. As you said, KELYA's for 74 years has been connecting people with meaningful work, millions in fact. It all started here in Detroit when our founders saw an opportunity to create access to employment for the thousands of women who were displaced from the production lines following World War II when the GIs returned from war. Since then, we've become a staunch advocate for the value of temporary and independent contractors and the value they bring to work in areas of science, engineering, technology, education, office, call center, just to name a few. We are a provider of both temporary staffing, permanent placement, outsourcing solutions, and we have earned a leading provider of education substitute teachers, and we're number 5 provider in the U.S. in engineering, science, and office, and we're a leading provider in the outsourcing space in our MSP practice. We're the most recognized talent brand in the U.S., which is something we've earned by focusing on talent, learning how people want to work, their priorities, and their work styles that they're pursuing. We were recently recognized as one of the top 10 world's largest staffing firms, and we were recently recognized by Forbes magazine as a number 3 professional recruiting organization in the U.S.
It's a fascinating history. Now, the company's been focused on accelerating changes to drive sustainable, profitable growth as a specialty talent solutions company. What steps has the company taken to transform the organization and accelerate growth?
Yeah, that's right, Joe. We are focused on becoming a specialty talent solutions provider, and there's really 2 prongs to our strategy. One is organic growth, and the other is inorganic growth. In terms of organic growth, in July we reorganized around our specialties that we intend to focus on. We believe this is going to create a more agile and growth-oriented operation. Those 5 specialties are areas we think there is significant demand, excellent growth potential, and areas where we can attract and place talent. The 5 segments that we're now operating under are science, engineering, telecom, and technology, education, professional and industrial, which we used to refer to as commercial, outsourcing consulting group, or OCG, and international. While KELYA has played in these areas for many years, by combining our assets this way, we're adding focus and scale to the specialties that we're focused on. And we believe this will lead to greater growth and opportunity. On the inorganic side, in February of this year, I announced that while we have been more acquisitive in the past few years than KELYA has historically, we're going to accelerate the pace of our M&A activity where it makes sense to support our growth aspirations.
So Peter, you mentioned acquisitions, and you mentioned over the past few years you've made a number specifically in the education and telecom spaces. Can you give us a little more color about why the company is focused on these areas and what the acquisitions have brought to Kelly?
Yeah, Joe, we've made acquisitions, as you said, in education. We made an acquisition earlier this year, and then as late as the past month. Um, and we've made acquisitions in the niche areas of telecom with two acquisitions in early 2019. We've also divested some businesses. We've gotten out of the legal and healthcare business. We've recently sold our staffing operations in Brazil, and we also sold our headquarters real estate in a sale leaseback arrangement that will allow us to deploy our capital towards growth. And the result is a more disciplined, focused specialty talent solutions provider. And where we will look to invest further inorganically are in the specialties where we think there's the most significant demand and growth potential, and that would be our science, engineering, technology, and telecom business, or SET, and our education businesses. And we believe this will make us position us well for future growth. And we're confident in our ability to deliver on this inorganic strategy because we have an enviable balance sheet. We have a history of generating free cash flow. We've demonstrated an ability to integrate the acquisitions we've done recently, and we've shown that we can delever.
Along with the acquisitions over the last 5 years, Kelly has placed significant emphasis on growing revenue and gross margin. And I think some of the acquisitions have helped drive on both of those metrics. How would you rate your success, and what are the company's long-term goals?
So, Joe, we focus on four principal measures: revenue, gross profit, EBITDA, and free cash flow. And we've made significant progress on 3 out of 4 of those. Admittedly, our revenue growth has been relatively flat over the past few years, which is why I've made top line growth a key priority for 2021 and beyond. In terms of the other measures, we're making progress over the last few years. In terms of our GP dollars have improved as a result of GP percent improvement from 17.2% in 2016 to 18.1% in 2019 as a result of structural improvements and a focus on customer profitability. We've also seen improvement in our adjusted EBITDA from 1.7% in 2016 to 2.3% in 2019 as a result of top line value drivers. And we have also seen improvement in our free cash flow. In 2016, generating 27 million, and in 2019, generating 82 million, which is very important to our inorganic growth strategy. And by point of reference, we've made $150 million of acquisitions in the past 3 years, and we left Q3 with 0 debt, indicating that, as I indicated earlier, we have the ability to delever as well as lever. In terms of long-term goals, Joe, due to the economic uncertainties, the pandemic, we're not providing long-term guidance at this point, but we're confident that with greater economic certainty, the prospects of vaccines, that we will resume normal guidance in February when we announce our fiscal year 2020 results. I would only conclude by saying, notwithstanding the current environment, the demand for the services we provide are promising, and that includes here in the U.S. as well as internationally.
You talked about a little bit on growing the top line as a priority, and some of the improvements that you've made. on gross profit. And I know you've made some investments in technology in your own firm, in for your front line, and I think some in the back office type also investments also. Can you talk a little bit about those?
Sure. We've taken a very principled approach to investing in technology, and the technology investments are intended to improve the productivity and speed with which we place talent at our clients. So we have just this year concluded a enterprise-wide implementation of a new front office system that allows us to plug and play the best technology in support of our recruiting and sales activities. But we're also investing in technology to support our clients in terms of solutions that we can bring them, as well as obviously investing in technology to always improve the efficiency of our operations.
Now, Peter, you did talk about the enviable balance sheet, and Kelly has a number of assets on its balance sheet, including its stock holding in Purcell and the joint venture. How did these relationships come about, and how do they fit into Kelly's business plan?
We started doing business with Purcell a number of years ago, and that uh, resulted in a strategic alliance that we entered into with Purcell in 2010 that involved essentially similar cross ownership of approximately 4 to 5% in each company. And in 2012, we initiated a joint venture to support staffing operations in 4 geographies in North Asia, and that was quite successful. So in 2016, we created a larger joint venture to include not only those 4 geographies, but another 8 geographies. So all of our Asia Pacific staffing operations are now supported through that joint venture. And we maintain a 100% ownership interest in our outsourcing consulting business in APAC, but our staffing operations are managed through the joint venture. And we've been very pleased not only with the results of the joint venture since its formation, but also in the increasing value in our shareholding in Purcell. So we have no immediate plans to divest these assets.
Okay. A key question that comes up in discussions with investors is the 2-share class structure in your stock and your controlling shareholder, the Adderley Revocable Trust. Can you talk about the class structure and the trust and its controlling position?
Sure, Joe. The Kelly has 2 classes of stock: KELYA, which is non-voting, and KELYB, which is the voting shares. The KELYB shares, a majority of the KELYB shares are controlled by, as you indicated, a trust, which was created when our controlling shareholder died in 2018. And I can say that since his passing, we have established excellent relationship with the trust, regular communications, and they have indicated to us that they are fully supportive of management and our plan and long-term strategy for the company.
That's great. And you touched on COVID. Can you talk a little bit about how the pandemic has impacted your business, what you've done, and what you are doing to combat COVID?
Joe, when the pandemic became a reality earlier this year, I sat down and put together 4 principles that we use to guide our decision making. The 4 principles simply are to protect the health of our employees, both temporary and our full-time workforce, to protect the long-term financial interests of the enterprise, to protect the employment of as many of our employees for as long as possible, and then finally, to continue to provide world-class service to our talent and our customers. And those principles have served us extremely well. In addition, a few years ago, we adopted what I would call a progressive work from anywhere mindset. And of created an IT infrastructure to support that. And as a result, when we went into lockdown in so many locations, we were able to continue to deliver seamless services to our talent and customers as a result, literally from day one. And we've also found ways to use that advantage to obtain new business from competitors who were less agile in pivoting to a remote work environment. And I would say another sort of silver lining in the pandemic has been our ability to identify new solutions to bring to customers that relate to the pandemic, but also introduce different kinds of work and different means of delivering talent that I think will survive the post-pandemic environment.
So you have to give congratulations to the management team for its pre-pandemic planning. What are you seeing today in terms of client and talent demand?
So in terms of demand on the customer side, Joe, it really falls into three buckets. A number of our business lines actually saw no decrease or maybe even increased during the pandemic. Those would be in our outcome-based work, our remote call center, our KELY Connect solution, our MSP practice, government solutions, and life sciences would be probably the star performers. There were a number of our other practices that were severely impacted in the first stages of the pandemic, light industrial, which were deemed non-essential, for example, automotive, and they have rebounded in a sort of gradual but consistent way through the pandemic, so that they are at or maybe even at higher levels than pre-pandemic, and that's primarily large accounts, customers that have reacted to the pandemic and have the resources to react to the pandemic and create a work environment that's safe for their employees and our employees. Science has also held up reasonably well, not only among large accounts, but also among smaller accounts. The businesses that have been most significantly impacted, to state the obvious, would be our education practice due to the school closings that began in March and have been coming back in fits and starts since then, as well as all of our businesses among or most of our businesses among small and medium-sized enterprises, which frankly have just been slower to recover due to their limited resources to respond to this unprecedented economic environment. So that's what we're seeing on the demand side. Perhaps I would add that in terms of pipeline and new contract wins, we're seeing positive developments across all segments, including education. In fact, we've won more business in the past 5 or 6 months than in all of 2019. So while their schools are grappling with the closures and this unique environment, they are still letting and awarding contracts, and we're winning more than our fair share of those. On the talent side, Joe, in those areas where there were shortages of talent pre-pandemic, so primarily in the professional and technical space, there continue to be talent shortages and demands given the ability of those jobs to quickly go to remote. So there hasn't been a significant interruption there. The most challenging part of the talent segment is at the lower end of the wage scale in the jobs, industrial jobs, where remote work is not possible. And we're not sure all of the reasons why there continues to be challenges, notwithstanding the much higher unemployment. But our supposition is that it's due to concerns about COVID-19, the challenges that working parents have with virtual schooling, the extended and enhanced unemployment benefits, as well as a reluctance of some companies to meet the wage levels that have been set by some of the big box companies like Amazon and Walmart.
So, Peter, what's next in the evolution of work?
Well, it's going to be a fascinating time to be in where we are, Joe, in right in the middle of the supply and demand for talent. I think in terms of the workplace, the pandemic has revealed to a lot of organizations that where the work is performed is not as important as the work outcome. I think in terms of work styles, we're going to see a less formal, less constrained work styles where employers will allow employees to achieve greater flexibility in their work environment. In terms of the workforce, the pandemic has revealed that notions about where work needs to be performed are maybe inconsistent with reality. Jobs that some people thought couldn't be done remotely have shown that they can be. And what that's going to mean is that companies can now look for talent not only locally where their brick and mortar is, but potentially nationally or even globally, which will open up access to talent and allow a company like Kelly to support our clients in creating workforce strategies that draw on larger pools of talent. And I think customers have realized in the pandemic the benefit of flexibility in their own workforces. And while it's still early, we're talking to customers and they're asking us about how to toggle the percentage of contingent workers that they have in their workforce to create greater flexibility, or to outsource through a statement of work of some of their non-core operations so they have an ability to create flexibility there as well.
Sounds like an exciting future for Kelly. Finally, Peter, can you tell us a little bit about yourself and how you became CEO of Kelly?
Yeah, so I have the privilege of being CEO for Kelly since October of 2019. I've been with Kelly for 18 years. And during our 75-year history, Kelly has gone through a number of important evolutions. And as CEO, I'm now in a position to lead us through this next evolution, which is about transforming Kelly to become a specialty talent solutions provider. And I'm very excited about that prospect. We're all about connecting people to work in ways that enriches their lives. Internally, that's what we call our noble purpose. It's what gets me up in the morning every day to come to work, and so many of my colleagues. And it's a privilege to work with the thousands of companies and the hundreds of thousands of talented people that we place in those great organizations. Being in the middle of this labor market equation has also revealed to us some injustices that exist in the labor markets, barriers that prevent more people from getting and finding access to meaningful work. And I've indicated recently publicly as CEO that I intend to make shining a spotlight on these barriers and ultimately working with like-minded organizations to tear them down, to create more opportunity for more people. I think it's good for the individuals, it's good for their families, it's good for the communities, and ultimately it's going to be good for the economy. We're calling this initiative Equity at Work, and it's something I am very excited about and intend to speak more about it in the future.
Couldn't agree with you more, Peter. Well, Peter, we covered a lot of ground today and got significant insight into what Kelly does, its markets and opportunities. We appreciate you taking the time to do this CEO interview, and we wish you and the company the best in the future. Thanks again.
Thanks, Joe. It's been my pleasure. Appreciate your time.
I really like this company, Joe. I have a couple of questions here. And regarding the company's business transformation, he talked a little bit about concentrating on certain verticals and then acquisitions, which we can get to in a minute. What do you think in terms of their concentration on those verticals, and how do you see revenues being enhanced by that strategy?
Right. So historically, Kelly operated as a broad-based staffing and outsourcing company, but this left them caught between scale and specialty offerings when compared to some of its large competitors, such as Manpower. So management redesigned the operating model to drive profitable growth in a select number of specialties, which include, as Peter mentioned, professional and industrial, the STEM area, education, outsourcing and consulting, and internationally. Um, these markets have a total addressable value for Kelly well in excess of 100 billion. So there's significant room for additional growth given the company's projected 2020 revenue run rate of about 4.4 billion. And I think they've aligned themselves in high growth specialties, the STEM, education, and we'll talk a little bit more here on the acquisitions of how that will also, the acquisitions are playing into helping to drive that top line growth.
Well, that leads right into my next question about acquisitions. It sounds like they've been successful in the past. What do you think the acquisition pipeline looks like, and how do you think that will enhance the company's growth going forward?
So we expect acquisitions to continue to play a key role in enhancing Kelly's market position in its select specialty verticals. For example, Kelly's leveraging its leadership in the educational vertical to expand into adjacencies. While historically in education, the company was focused on the K-12 teacher market, the recently announced acquisition of Greenwood Asher expands the company's reach into the higher educational market. We expect to see additional target acquisitions in this market going forward. In the STEM space, where Kelly enjoys a top 5 market position, the company acquired 2 firms, NextGen and GTA, to provide a stronger offering to the fast-growing 5G space. In addition to positioning Kelly in faster growth markets, these acquisitions bring in higher margins. So we think there's a big pipeline. They're being very selective in their acquisitions, looking to not only drive top line revenue growth, but also to enhance margins.
And Joe, can you talk a little bit about the balance sheet and how it can support acquisitions, and what has been history, what in terms of how the company manages its balance sheet in past acquisitions?
Sure. So we believe the balance sheet is a key competitive strength of Kelly, especially in these COVID challenged times. They have 0 debt, significant unused borrowing capacity, and in addition, they have a number of assets on its balance sheet that we believe are unrecognized in the marketplace. For example, as Peter mentioned, Kelly owns approximately 4% of Persol Group, which is a Japanese staffing firm, which was valued at 145 million, or over $3.50 per Kelly share at the end of the third quarter. In addition, they're a 50% owner of a joint venture between Kelly and Persol that was valued at 115 million, or nearly $3 per Kelly share at the end of the quarter. We don't think these are recognized in the marketplace. And as Peter mentioned, also the company has had a history of strong free cash flow, and they typically, once they've gone out and acquired a company, have quickly turned around and paid off any debt associated with any acquisition. So we think there's a strong acquisition pipeline, enviable balance sheet, and with the strong cash flow operations, that it allows them to be in the driver's seat where it comes to making acquisitions to help drive top line growth and margin improvement.
What a great company. Thanks, Joe, for bringing Peter to us. Thank you.
Thanks, Michael.
This has been the C-Suite Interview Series, brought to you by Channelchek and Noble Capital Markets. Log in to Channelchek or subscribe to our YouTube channel to get the full catalog of C-Suite interviews and virtual roadshow channelcasts. Register for Channelchek's no-cost premium content and receive notifications of new releases from both series. Thank you for joining us.